Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for May 27th of 2025. Well, happy Memorial Day to all of you out there. Hope you're having a great long weekend. Let's jump into the chart, shall we? We talk a lot about the global fund manager surveys from Bank of America, and so this is a sentiment indicator. Looking at some guidance here as far as where the fund managers feel like we're heading in terms of the economy. Up here, we've got 61%, no, just under 2/3 say that we're in for a soft landing. A quarter say that we're in for a hard landing, and then in this green section down here, you've got fund managers that say that basically we're just going to soldier on without really much change. And you can see how that really changed in April. We had, I'll call it the tariff tantrum. And we had that so-called Liberation Day at the very beginning of the month, and that changed opinions very quickly. Obviously, it soiled the markets. And we had a big turn, lots of volatility, and we've certainly improved off that level. Although I can say that we haven't recovered to some of this more complacent attitude, going back into 2024. But at least it's better than it was. Here is the Conference Board Index of Leading Economic Indicators. And just by way of reference, this goes back to 2000. So, we had a long period of updraft here, and then we rolled over in the global financial crisis. It took us several years to kind of build our way out of that deficit in terms of where the LEI, the aggregate level of the index was. But we had a very long protracted expansion here there was much talked about before we hit the pandemic, and then we had a crescendo in 2022, and then we've seen this decline ever since. Now we obviously have not seen the recession that might be implied by this decrease, and we've created kind of in terms of the index value itself, we have created a bit of a deficit, but we're still working our way out of it. On this slide, we'll take a look at some of the components of LEI that we just looked at. And as you can see here, really, there are puts and takes. Now, the LEI we know has been, weak and has been decelerating, but that's not to say that everything in the LEI is weak. Here's the aggregate level, and here's a trend. You even see some areas of strength here. We've got unemployment claims. We know that certain elements of the labor market remain fairly strong, and we actually have consumer goods and material orders that are still relatively strong and are in fact accelerating at this point. So really no indication from the consumer yet that acquisition strategies are decelerating here. Now we've got other areas that are, I would deem, okay, whether it be leading credit index, although we've seen some deceleration there. Clearly, we'll take a look at some credit issues. Interest rate spreads, we've seen some flattening in the curve, rates moving up higher in the aggregate, but right now that remains relatively stable. S&P 500, we've seen some pockets of outperformance there, some recovery from some of the April turbulence there. Building permits, we've got a lot of housing data coming up in the chart pack. That we do see as decelerating, and then new orders for non-defense capital goods, excluding aircraft, still okay, but those are actually accelerating. So again, we've got pockets of this Institute for Supply Management, new orders index. You see that accelerating too. So again, where we might have weak or okay data, there's elements that are accelerating, there are pieces of it that are decelerating. Here is the coincident economic index. So this is more. This is kind of looking forward. This is kind of looking at where we are. And all of these elements are strong, but we do see income level and trends in income decelerating, as well as manufacturing, which is to be expected given the tariff regime that we're now in. Here we have some University of Michigan expectation numbers on the inflation front. You can see here the one-year number. The May reading actually exceeded expectations, and not too surprisingly with the advent of tariffs and this discussion over tariffs, however long we may be held in abeyance with regard to some of the higher tariffs, those expectations have gone up. And what's really, I think, more surprising to me than anything else is that the 5 to 10 year inflation expectations have also moved materially higher. And this is a number that tends to stay more range bound. And for this to explode out is really kind of telling here. And you can actually see that here in the blue line here. We've got the University of Michigan expected change in prices next 5 to 10 years. This is in this aqua line. You can see where that's moving higher here, and this black line represents the inflation break even. This is what the bond market is telling us right now, whereas this is a survey of individuals and their expectations. So to see a breakout like this is pretty dramatic, and I think it does revert to the mean. I don't think we stay at 4.5% inflation. That would not be terribly good. Obviously, it would mean that the Federal Reserve is not able to do its job. So again, this is, I think, an emotional reaction to everything going on. Whereas we look at this line, this black line, this is what they call a double forward in a sense. It's the 5 year inflation expectations 5 years from now. And so you can think of it as a 10-year expectation, but it's really trying to look out on the horizon and what would those expectations be for 5 year inflation, 5 years forward. And so that number is still around 2.8-ish, and it seems to be pretty well anchored. And so this is a very unusual circumstance. You can see going back, probably 2004, how this number kind of overlaps, and to have it break out like this is actually rather unusual. And although you do see deviations from actual inflation in real time relative to the expectations number, but it is very rare to see something like this. Kind of looking at things in a little bit more of a broader stroke here, you've got both estimates for CPI, Consumer Price Index, PCE, Personal Consumption Expenditures, and this would be the core PCE, and you can see that the current estimate looks for those to migrate higher, again, not spike higher as we saw in that last chart, especially for that 1 year, but this would be the consensus for inflation to move a little bit higher over the next year as we head into the middle of the 2025 summer. Okay, Consumer Sentiment Index. This is not the inflation. This is another piece of the University of Michigan survey, which we saw. Sentiment is pretty low, which makes sense. We saw the inflation expectation for the 1 year spike higher. That would tend to correlate pretty highly with a pretty lower, with a much lower consumer sentiment number. Here's our expectations index. That's looking forward. Here's current financial situation compared with a year ago. Lower, and expected change in financial situation a year henceforth. That one really dropped. And so when you look at this in total here, the consumer is still spending, oddly enough, but they're less optimistic. Now that doesn't always translate into lower behavior. It's just how they feel when somebody asks them the question. And oftentimes you see some deviations between what they say they're going to do and what they actually do. Here we have import and export data. We've got import price index, ex petroleum. You see import prices moving higher. They were in fact ahead of expectations. We'll be working on the May numbers here as we head into the next few weeks. Then you got manufacturing production month over month was a little bit weaker. So again, things that you would expect with a tariff regime that's higher than what it was. We're going to look at a chart here in a second that you can see where the average tariff has gone from like 2.5% to like 18%. And so when you have that kind of change, you are going to see these types of numbers. Here we have container departures from China to the U.S. And a lot of these are going to the Port of Long Beach, Port of LA. but not too surprisingly, Liberation Day, we had a rather significant drop. And this is real data. This isn't sentiment. This is actually container ship counts that are leaving China heading to the U.S. And so we had a bit of a reprieve here when we kind of struck this interim deal with China to go down to 30% tariffs. And you can see that those are moving lower again. So, and they're back at kind of February-ish levels. And but you can see that, we've had a pretty decent run overall. This number can be a little bit noisy. But directionally, we definitely see this slowing down. Now, looking at employment, this is just looking at the Mag 7. And I thought this was really interesting. It doesn't tie necessarily to any other chart other than, we have talked about the labor market as being relatively, resilient. But you can see here that hiring amongst the Mag 7 has actually been pretty low. And so that tells you two things. One, we might have been able to get increased productivity. We do know that, that factor productivity as it's calculated has been higher, but they've certainly been able to generate more output with fewer employees amongst these Mag 7 companies. Whereas, looking over the prior decade, if you will, worth of data, you can see there was a tremendous amount of expansion that's not present now in terms of headcount. Tariff timelines, this is just kind of putting things into perspective. Again, we were, looking at a Chinese tariff rate that was probably closer to 10%, on a baseline. And this is February 2025. So it's not a long look. And then we hit uh, the tariff tantrum or the Liberation Day, and of course these spiked up, and then you had the retaliatory tariffs, and so now we're down, back to around 30%, as I mentioned in the prior slide, and but that's significantly higher than where we were when we entered into this stuff, and so that's why we have this gap here. Is why we have down to what 10%. That gap is why we have fewer container ships. That's why we have import prices moving higher, and you just can't escape the impact of a move like that. Even though when you read the headlines, you feel like, oh well, we solved our problems with China. Well, yeah, maybe we forestalled them, but there's still high tariffs that are at play. Here we have the effective tariff rate, which I just mentioned. We started off at around 2.5%. And you can see that now we're at, roughly 18%. I guess if you reduce that, the reductions on China, the 30%, that brings you down to 13% overall. But again, you could see that there's a huge delta between where we were when we started the year and where we are now. And I think some people have it at 14, some people have it at 13. And if you look at the ex-China impact, I mean, it's very high. So here's a quick look at China again. We had this is going back a long time. Again, I love these long-term trend um, charts, and this is going back to 1821. So, which really impresses me how we're able to keep track of all this data during then. But, we went from a protectionist isolationist society to one that was much more open with free trade. And you can see that trend really took root after World War II. And, with, the announcements that are out there now, again, if you believe 18 or you believe 13, the China adjustments here, again, I mean, these are tariff rates that we haven't seen since the Smoot-Hawley tariffs back, which preceded the Great Depression. So interestingly enough, the rhetoric which was anticipated certainly by the administration in announcing these tariffs was that you're going to have reshoring of manufacturing and supply chain. And in fact, that has manifested itself in this data. This is basically earnings call transcripts, and you dissect them, and there's services that will, certainly AI that'll do that, and they'll say, well, how many mentions of reshoring or bringing manufacturing back to the U.S. Have there been in these conference calls? And clearly a lot. Whether you're talking about the S&P 500 or whether you're talking about the much broader Russell 3000, which encompasses mid and some small cap companies there as well. We talk about government bond yield. So, one of the things that I do worry about is if you have a failed bond auction. Of course, the Treasury is having to constantly issue new debt for maturing debt to keep the government funded, and so they're issuing at prevailing market rates. They're retiring the debt if it was at prevailing rates at that time, and so but the risk is that you have less demand, and we'll see in a second that we have had less demand for U.S. Treasury auctions from overseas buyers because of a lot of the things that we've been talking about. And so what happens is when you have basically you've got less demand, your prices are lower, but your yields are higher. And so we see here both, and there was a particular 20-year auction last week, which had some trouble. It had lower demand. And so we see these higher rates, 5%. And then you see here in the 30-year government bond, you've got basically, 5.09, which is interesting because, you had a spike in the 20-year to 512, and that's above the 30-year rate. So you go 10 more years out on the curve, and you actually get a lower yield. So that kind of blows up the term premium theory. But this is driven a lot by the fact that we're coming into this new era where we're gonna have to find different kinds of buyers for treasuries. Certainly with all the deficits from a fiscal standpoint that we're facing, Treasury's going to clearly need to have to issue more treasuries, and the question is who's going to be buying them. And I think if we have this situation, that we might continue to have these higher rates at the long end. As I mentioned, we've had a little bit of a decline in foreign participation in Treasury auctions, and this is very noisy data, but trend line as of late has been down. Foreign holdings of U.S. Treasuries, we can see very actively that China, over a number of years, has been paring down its holdings, while meanwhile we've seen the UK increase its level of holdings kind of after Brexit, and then Japan has been pretty steady along the way. Here we have corporate earnings, beginning to see some of the impacts here. So, we certainly have wondered after the tariff regime here, and what's the impact on earnings going to be? And we've already seen a bit of a deceleration. We've seen some earnings estimates come down, which I thought was very healthy. I thought they were way too high coming into this year, but as we track into the early part of 2025 and into May, we clearly see that there's been a bit of deceleration. But there are times where you see these decelerations that again don't correspond with recessions that are in these gray bars here. But this is we've seen some relative momentum in earnings coming out of 2022. That is seemingly unwound at this juncture, but I do think earnings estimates are a bit more realistic than they have been. Well, and interestingly enough, in the last couple of readings here, this is the Citigroup Earnings Revision Index, and so the ERI, we've actually had a couple of notable upticks in the last couple of weeks. So, and that comes after a significant period of earnings downward revisions. Here we have University of Michigan. This is part of that U of M survey that we were just looking at earlier. But this is their probability. They're asking respondents, what's the probability of increase in stock market prices over the next year? And of course, they were pretty despondent over inflation and financial conditions, etc. So it doesn't surprise me that their expectations for stock prices over the next year are pretty low as well, even though they are off their bottom from an interim standpoint. Here we have increase in sentiment from the American Association of Individual Investors, AAII, the bull bear spread, which have been really, really bearish. I mean, going back to 2022 levels, in fact, but that has reversed itself, at least for the time being. And then you see retail purchases is in these bars here, the purple bars. And you can see that that's actually, if you look at over a number of weeks, you can see retail investment in public equities has actually increased, which would be consistent with this rise in sentiment from an individual investor standpoint. Something else that we've been monitoring, again, not that it's happened overnight or whatever, but even like starting from the beginning of the this new century here, the 21st century, you can see that there's been a steady rise with some notable spikes with economic recessions. A notable like trend up in the number of Russell 2000 index constituents that actually have negative earnings that aren't making money. Right now, that's actually, call it like 42, 43% of the Russell 2000 actually has negative earnings at this point. We've got a little bit of valuation data and also some trend line data looking at different asset classes. And so here we have the S&P 500, trailing 12-month revenue growth as of the end of last year was about 8%. And what's interesting is we look at some of the private capital markets, and this would be emblematic of that. The U.S. middle market private. I mean, this is an index of private companies now. That number is considerably higher, about 12%. So this is what folks are trying to tap into with some of these increased allocations to private capital, private equity. You can see here the MSCI, these are international indices, lower growth. And as we mentioned just a second ago, Russell 2000 overall at only 3%, but recognizing that about 43% of the index is actually losing money. So a big a delta or difference here when we talk about revenue growth on the part of public versus private companies. Here we have the 12-month forward PE ratio looking at some of these different indices. So this is the S&P 500 in gray. And you can see, we reached 16.8, which is very close to normal in 2022 on the S&P 500. You can see it went from like basically 20 to almost 22. We're sitting at 20 now. So again, we're not expensive. We're certainly not cheap. Oddly enough, you can see NASDAQ with some of the re-rating and some of the technology companies, the average forward PE ratios have actually come down quite a bit to a level which is arguably a lot more reasonable. And then Russell 2000, again, when you're talking about small caps and a lot of those not making money, it tends to inflate your PE ratio here. So the best of the lot continues to be the S&P 500, but still not cheap in the aggregate. Here we have buyout, enterprise value to EBITDA. So this is really looking at the private market. And so, we're very interested in kind of like the trends in multiples for private equity right now, because, it seems to be getting a lot of press. And there are lots of merits for private capital, but you don't want to be going into it at the wrong time. And in this case, going from 2022, really frankly from 2020, when we had middle market price to earnings ratios here of about 14 times, again, significantly cheaper than the public markets. But you can see that has really kind of gone down over a period of time, maybe a slight uptick here. 22 to 23, but the trend line is down, and it really is down in all of these areas. When you talk about like large cap, that got more expensive in 2021, but certainly in mega cap private equity, these valuations have come down. And so, I think what it does is argue for some allocation, some increase in allocation, because you're getting these things that have higher revenue growth, that are trading at arguably cheaper valuations than you can see in the public markets. Another thing that I find particularly interesting that's highlighted in this chart from FS Investments is that private equity funds that are looking for very large transactions have a lot of capital. I mean, they've got basically $500 billion or close to it in dry powder that can be deployed. So I think there's going to be, more transactions, and it's we're going to see more turnover in the public and private markets. So deal supply is something else that we look at in terms of the private markets. This would be year to date, so that's why that's considerably lower. I think we're tracking something less than what we saw over the last 4 years. But I'd say deal flow is holding its own, and when you look at the share of really big transactions to ones that are kind of fit, this would be kind of the middle market, and this would be the large and mega cap. I mean, obviously, the ratio seems to be holding true. We're just haven't been seeing as many exits lately as certainly that we probably would have expected, given all the dry powder that's out there on the horizon that is ready to deploy. I do think when capital markets kind of settle out, that we'll see better numbers out of these transactions in 2026, particularly in 2027. We get a couple of years out. I think that market is going to be particularly healthy. Here we have free cash flow yield. This is something that doesn't get a lot of press, but I found it very interesting that we haven't seen a free cash flow yield, and this would be like basically taking your operating cash flow, which would be your net profits, and subtracting the net drag from your working capital and maybe a couple other items, and then subtracting from that your maintenance capital spending, and getting to a free cash flow yield. We haven't seen this in a while. So I mean, profits, ironically, profit margins are relatively high, but the cash flow, the free cash numbers are actually not nearly as good as that. So sifting through all the data, we're trying to make sense of where interest rates are headed. This would be basically the market implied change in the overnight rate. So this would be short-term rates, and basically as of the 19th of the month, which is a little bit more than a week ago, we were looking at the increased potential for rate cuts. Basically September 2025. I mean, really not much action until July, and I think even that's going to be pushed back unless we see material erosion in the numbers. In fact, we won't even get second quarter GDP until after the Fed meets. So I definitely don't expect a rate cut then, but more likely getting into September, October, and also December. Currently, we're still looking at maybe 2 rate cuts by the end of the year based on the current consensus indications. Now for a couple of charts on the deficit and U.S. debt side. I do think this is something that's really not getting important coverage right now, and a lot of it's because you've got two sides of the aisle, both sides of the aisle, that really don't care about this right now. Certainly on the GOP side, pushing for the extension of tax cuts with all sorts of kind of new spending and the state and local tax exemptions that have been recently raised and offered as a part of this deal that they're budget that they're trying to get through. But here we have this debt as a share of GDP continuing to move higher, and if there's a way that we could possibly attenuate this, I think our country will be in much better shape. I mean, we're basically almost at 100% of GDP now. And if you look out essentially 10 years, you're going to be at close to 120%, which is astounding. 20 full percentage points as a share of GDP, which we know itself is apt to rise, on average about 3+% a year anyway. So this is some data from Deutsche Bank with historical data from the Congressional Budget Office, and you can see here, you've got 2034. This is Moody's, and we were looking at another forecast before that was close to, this is actually a little bit more accelerated than what we just looked at, but Congressional Budget Office, expects, something, obnoxiously high, like 156% in over the next 30 years. But again, both of these are looking, looking much higher than where we were. And this is deficits as a percent of GDP. So this is debt held by the public, and this is deficits as a percent of GDP. And you can see that those deficits, based on what's currently being discussed in Washington, continuing to expand. This is not sustainable. There's comes a point where you can't find enough buyers for all the debt that you're trying to sell, and that's going to force your hand. It's going to force you to become more fiscally responsible. I just don't know when that's going to happen, because the inertia is not there for us to do it now before all these problems manifest. It's going to take true leadership in Washington, excuse me, to get to that point. So credit side, we saw in the LEI data that credit is not really a problem yet, but it is heading in that direction. We don't mind seeing little movements in the data, but right now we're seeing trend lines, and this is just auto. We've looked at credit cards, we looked at a lot of things, but you can see, going back to the global financial crisis, that we're pushing through those levels, particularly on the subprime side. These are the lesser quality things. We haven't seen that on the prime side, but we certainly have seen delinquency rates meander a little bit higher. So here we have personal consumption, the forecast coming out of Morgan Stanley. So as we look at second quarter, which we'll get data on about the third week of July, and expect it to be strong enough to kind of hold its own, but then weaken up over the next several quarters before regaining some strength. And I think this is a very reasonable forecast for personal consumption based on what we see now. And this is like, where are they going to spend that? So you got goods versus services, and we do know that goods prices are likely moving higher to the extent that there are goods that are imported from overseas, because we know that there are increased tariffs. And so, not too surprisingly, you've got goods purchases which are already moving down in response to that and are likely to remain negative for some time. So how do you get to this personal consumption expansion here? Well, it's clearly through services. This estimate by Morgan Stanley, which again I think is pretty reasonable, is really assuming a pretty sluggish environment for goods spending, looking out over the next several quarters, but that you get a resumption in momentum out of services, and you get positive performance out of goods. You just have to wait several quarters for it. Quick note on manufacturing. We don't have too many slides on this. We'll start looking at some regional survey data here in the coming weeks. But we've got the Philly Fed and the Empire State, which represents the New York region, and manufacturing conditions index is really improved. At least on the Philly side. New York side, we see an uptick. It's still negative, but it's an uptick that kind of reflects a slightly more positive or maybe less negative tone, which is very interesting despite tariffs out there. Here we have actually a lot of data, but this is something that I thought was really interesting. So This is the health. This is kind of a commentary on the health of pensions and then how they're allocated down here. So, there's many, many years where even when the stock market was moving higher and we had low inflation, we still had funded ratios that were really abysmal and pensions that would struggle to meet all of its obligations. And, you want a funded ratio of 100, that means that you have enough money in your fund that can fund all of your future liabilities to pensioners out of that fund. And oddly enough, and even in 2022, which was a difficult year in the market, we were very close to that. And you can see that we've made a lot of progress on our pensions over the last several years. And what this does is it takes a lot of stress off the federal government and the Pension Benefit Guaranty Corporation, the PBGC, on having to make good on pensions for, if we hit a very tough economic stretch and you get pensions that are busted, the government's got to come in and bail them out. And but when your funding status is at or above 100, you're in a lot better shape to weather those storms. Down here is really looking at more of an allocation. And what's interesting here is we know that in this green section here, alternatives, this would be like private equity, private capital, that it's always played an outsized role in institutional money management. But you can see here, 21%, 22%, that really going, looking past the pandemic, that we've had an increased role in alternatives. And there are some institutional investors out there that have this green area is more like 40% rather than 20%. But you can see, fixed income is becoming a bigger piece of it, and with that comes, the desire for higher yield. They're not just investing in treasuries here, but it's very interesting to see that, equities seem to be getting pinched over time in favor of privates, as well as being innovative on the income side. Here we have in that now we're going to really get into the real estate charts and kind of end there. So anticipated rent inflation in the next year, you can see that has picked up here. This is the owner's equivalent rent trend, as well as the Federal Reserve Bank and Fannie Mae 12-month. These are all like on a 12-month lead here, these last two. And this is real-time data. So as we kind of pull that forward, you'd expect to see owner's equivalent rent move a little bit higher here in the coming months. Housing starts are pretty anemic. You can see here they're down 11.6 in the month of April, and they've remained sluggish. So this is not a particular surprise. Here we have multi-family units under construction, also down, but coming off a massive, build here in multifamily, and particularly like, after the pandemic. And so it was apt to come down. We've seen this number come down for a number of months now. So again, not a surprise, but a trend that seems to be reaffirming. Now we've got National Association of Home builder sentiment numbers, and those also remain weak. Some of this has to do with price points, affordability, but also access to capital and cost of materials. And when you're looking at tariffs and the cost of lumber coming in from Canada, even though now we're at kind of a 10% baseline tariff with Canada, and forever, however long that's going to hold. Sentiment is just a little bit weaker right now. And you can see the traffic of prospective buyers, because of the affordability issues, a little bit lighter as well. Got some more data here on housing. You've got housing supply, which interestingly enough has perked up over a period of some months. This is the supply on the market. So getting us back to, this is an aggregate number of 2 million. So this would be something that we haven't seen since before the pandemic. You've got existing home sales. This is basically a number of units, and existing home market is much more important than the new home market is in terms of raw numbers. And so see that we've been very sluggish on home sales, which just dropped to a bit of a 6-month low here. We got home prices too. So again, we talked a lot about home prices here during, the 2020 to, really 2023. And then we had this, marked deceleration, and then we had this pickup again. And so now we're in another downslope. And I think this kind of reflects maybe sentiment. It reflects, near-term prospects for economic growth. But it is notable in the sense that we're getting a decline in home prices right now at a time where affordability is a little challenged. Now we've got the mortgage rate on a 30-year fixed, which, with all of the little interim noise here, has remained relatively steady, over a fairly decent time frame. We're just under 7% here on the 30-year conforming. Now we've got another chart which I think is really interesting. It's kind of like a changing of the tides, and as BCA research kind of put it, I mean, there's really no pure manifestation of the lags in monetary policy than something like this, because you raise interest rates, and particularly on the 10-year, which the Fed doesn't necessarily target, but it happens due to inflation expectations. But here you see a dramatic rise in the number of mortgages that are being priced at above 6%. That was in 2022 when we kind of saw that trough, excuse me. We were looking at like maybe 4%, and now that number is looking like 20%. And meanwhile, all of people like me that happen to have mortgages, that are blessed to have mortgages at less than 3%, you when you move and you relocate, I mean, you're having to take on higher mortgages, and so naturally that number is going to drop over time. We'll conclude on a couple charts here. You've got homeowners' equity in real estate, which, again, for all the noise in the near-term housing data, the value of housing stock, $35 trillion almost, and has continued to move higher. So this is basically one of the major assets that anybody will ever have if you're a homeowner, and you can see how much that's increased, and really what represents kind of here's 10 years ago, and that number was 12, and so now you're at 34. You can see the tremendous amount of value creation and wealth creation due to increased homeowners' equity. And finally, as it pertains to kind of a starter price for homes, I came across this, and it really tells the story of affordability and why it's taking people longer to buy their first home. Is you have 233 cities in the United States where a typical starter home is more than $1 million. And here's Texas right here. We've got 7 cities which fit that description. Obviously, you get into California, New York, New Jersey, East Coast and California. It's much more prevalent there than in the interior states there, but still, it's reflective of a broader issue of homeowner affordability for first-time home buyers, as well as affordability in general. That's all we have for the chart pack this week. Hope you've enjoyed it. Have a great week, and we'll talk to you again soon. Take care. Bye.